Chapter 1. The Illusion of Invincibility. There's a peculiar phenomenon that occurs at the peak of success. It's quiet, almost imperceptible at first, but it grows with every achievement, every milestone, every quarter of record-breaking profits. It's the illusion of invincibility, and it has brought down more empires than any competitor ever could. Imagine standing at the summit of a mountain you've spent decades climbing. The view is breathtaking. You can see everything from up here, the entire landscape of your industry spread out below you. You've earned this view through hard work, innovation, and countless right decisions. But here's the trap. The higher you climb, the harder it becomes to see the cracks forming in the ground beneath your feet. Overconfidence in past success is one of the most dangerous forces in business. It's not loud or dramatic. It doesn't announce itself in board meetings or appear in quarterly reports. Instead, it seeps into an organization like water finding its way through stone, slowly, persistently, until the entire foundation is compromised. When a company has been successful for years, even decades, something shifts in the collective mindset. The strategies that brought success become sacred. The leaders who implemented those strategies become untouchable. And the notion that the world might be changing in ways that require a fundamental rethinking becomes almost offensive. After all, why would you change a winning formula? But here's what history teaches us, again and again. Past success is not a guarantee of future survival. In fact, past success can become the very thing that prevents survival. The methods that made you successful 5 years ago might be precisely what makes you irrelevant 5 years from now. The market doesn't care about your legacy. It doesn't care about how dominant you once were. It only cares about whether you're meeting its needs right now, in this moment. Think about the greatest empires in business history. They didn't fall because they were suddenly bad at what they did. They fell because what they did so brilliantly had stopped being what the world needed. They fell because they kept perfecting yesterday's solutions, while someone else was inventing tomorrow's questions. This brings us to something even more insidious: leadership hubris. When executives have been at the helm during years of prosperity, they begin to believe that they possess some special insight, some unique genius that makes them immune to the forces that bring down lesser companies. They look at their competitors' failures and think, that could never happen to us. We're different. We're smarter. We're better. Leadership hubris blinds organizations to reality in the most fundamental way. It creates an echo chamber where dissenting voices are dismissed, where warnings are seen as pessimism, where data that contradicts the prevailing narrative is ignored or explained away. When a CEO has been lauded as a visionary for a decade, who in the organization has the courage, or frankly the career security, to stand up and say, I think we're headed in the wrong direction? The most dangerous meetings are the ones where everyone agrees. The most dangerous organizations are the ones where questioning the strategy is seen as questioning the leader. And the most dangerous leaders are the ones who have forgotten that they, too, can be wrong. History is littered with executives who were celebrated as geniuses right up until the moment their companies collapsed. They gave TED Talks. They wrote best-selling books. They were featured on magazine covers. And through it all, they genuinely believed they had figured out something that others hadn't. They believed they were special, right up until they weren't. But even companies with humble leadership and realistic self-assessment face a universal truth. Even giants can fall if they stop adapting. Size is not armor. Market dominance is not permanent. A billion-dollar valuation is not a shield against obsolescence. The graveyard of business is full of companies that were once considered invincible. Companies that dominated their industries so completely that it seemed impossible they could ever be displaced. They had the best talent. They had the most resources. They had brand recognition that transcended their products. And yet they fell. Why? Because they stopped adapting. Or more precisely, they adapted too slowly. They saw the changes coming. They acknowledged the shifts in technology and consumer behavior. They even started initiatives to address these changes. But they did so at the pace of a giant, which is to say, too slowly for a world that moves at the speed of innovation. There's a particular kind of tragedy in watching a massive organization try to change course. It's like watching an ocean liner try to avoid an iceberg. Everyone on board can see the danger. The captain gives the order to turn. The crew springs into action. But the ship is so large, its momentum so powerful, that it simply cannot turn quickly enough. The collision becomes inevitable not because anyone wanted it, but because the physics of size and inertia made it so. Large organizations have structural advantages, resources, talent, infrastructure, market access. But they also have structural disadvantages, bureaucracy, committees, approval processes, stakeholder management, legacy systems, cultural inertia. Every decision requires consensus. Every change requires coordination across dozens or hundreds of teams. Every pivot means retraining thousands of employees, updating countless systems, and explaining to shareholders why the strategy that worked for the past 10 years won't work for the next 10. By the time a giant organization has fully committed to a new direction, the market has often moved on to something else entirely. This is how nimble startups, with a fraction of the resources, can displace companies that seemed unbeatable. It's not that the giants are incompetent. It's that they're structurally incapable of moving at the speed required for survival in a rapidly changing world. And nothing changes markets faster than technology. Which brings us to perhaps the most consistently lethal force in business history, the slow response to technology shifts. This is the silent killer, the one that takes down even the most vigilant organizations. Technology shifts don't announce themselves with trumpets and fanfare. They start small, in garages and dorm rooms and forgotten corners of the market. They look like toys. They look like niche products for hobbyists and early adopters. They're easy to dismiss because they don't serve the mainstream market yet. They're not good enough, not reliable enough, not scalable enough. Until suddenly they are. The pattern repeats itself with stunning regularity. A new technology emerges. Industry leaders look at it and see all the reasons it won't work, all the ways it doesn't serve their current customers, all the barriers to mainstream adoption. They're not entirely wrong. The technology usually does have significant limitations at first. But while they're cataloging its flaws, someone else is working to fix them. And then, almost imperceptibly at first, the new technology crosses a threshold. It becomes good enough. It starts serving real needs in ways the old technology can't. It starts attracting not just early adopters, but mainstream customers. The market begins to shift. And the companies that dismissed it suddenly find themselves on the wrong side of history. The tragedy is that these companies usually see it coming. They have research departments. They attend conferences. They read the same articles as everyone else. They know about the emerging technology. But knowing about something and truly understanding its implications are two very different things. And understanding implications and actually doing something about them are different still. So they watch. They analyze. They form committees to study the situation. They create small experimental divisions to explore the new technology. Meanwhile, their core business is still generating enormous revenue. Their traditional products are still profitable. They're existing. Customers are still buying. The quarterly earnings are still meeting expectations. Everything looks fine, right up until it doesn't. This is how the silent killer works. It doesn't attack head-on. It erodes slowly, quarter by quarter, customer by customer, use case by use case. By the time the impact shows up in the financial statements, it's often too late to mount an effective response. The organization wakes up one day to discover that the world has moved on, and they're still perfecting products that nobody wants anymore. The illusion of invincibility is so powerful because it feels like wisdom. It feels like confidence earned through experience. It feels like the rational response of successful people who have proven themselves time and again. But it's a trap, and once you're caught in it, escape becomes almost impossible. The very success that created the illusion becomes the weight that pulls you down. Chapter 2. Early warning signs that go ignored. Every collapse has a prologue. Every downfall has a moment, or more often, many moments, where the future announces itself quietly, politely, giving the organization a chance to change course. These are the early warning signs, the subtle cracks in the foundation that appear long before the building falls. And almost without exception, they are ignored. It's not that leaders are blind or foolish. It's that early warning signs are, by their very nature, easy to dismiss. They're anomalies. They're outliers. They're minor issues that can be explained away with a dozen reasonable-sounding justifications. And in the noise of running a complex organization with 1,000 problems demanding attention every day, these quiet signals get drowned out by louder, more immediate concerns. But here's what makes this so tragic. The people who see the warning signs first are rarely the people in power. They're the ones on the front lines, the ones actually interacting with customers, using the products, competing for sales in real markets against real competitors. They see the shifts in customer sentiment. They hear the complaints that aren't making it into formal feedback channels. They notice when a competitor's product starts winning deals that used to be easy victories. They feel the ground shifting beneath them. Ignored frontline signals often precede disaster because the people closest to the reality of the market have the least influence over strategy. They send their observations up the chain, where each layer of management filters, interprets, and softens the message. By the time information reaches the executive level, it's been transformed from "our customers are starting to prefer the competitor's approach" into "we've seen some minor shifts in certain chapters that we're monitoring." The salesperson who's losing deals knows something is wrong. The customer service representative who's hearing frustration in every call knows something is changing. The store manager who's watching foot traffic decline week after week knows the business is in trouble. But their knowing doesn't matter if no one with power to act is listening. And even when these signals do reach leadership, they're competing with something more powerful: the comfort of established metrics. Revenue is still growing. Market share is still stable. Profit margins are still healthy. The dashboard is still green. How can there be a problem when all the numbers say everything is fine? This is how organizations fail in plain sight. The numbers lag reality by months or even years. They measure what happened, not what's happening. By the time a decline shows up in quarterly results, the conditions that caused it were set in motion long ago. The frontline employees saw it. They reported it. And they were told, implicitly or explicitly, that their concerns were overblown. There's a related problem that compounds this. When leaders do finally acknowledge that something is wrong, they often fail to define the real problem. This leads to the wrong fixes, which waste precious time and resources while the actual problem continues to grow. Defining the real problem is harder than it sounds. When sales decline, is the problem the sales team, the pricing, the product, the market, the competition, the economy? Each of these explanations leads to a completely different solution, and choosing the wrong one can be fatal. The natural human tendency is to define problems in ways that are comfortable and familiar. If you're a leader who came up through operations, you'll see operational problems. If your background is in marketing, you'll see marketing problems. We define problems in terms of the solutions we already know how to implement. This is why so many organizations respond to market disruption by doubling down on efficiency, as if the problem were that they weren't executing their existing strategy well enough, rather than that the strategy itself had become obsolete. The wrong fix is often worse than no fix at all because it creates the illusion of action. Leadership can point to initiatives and investments and changes. They can tell themselves and their stakeholders that they're addressing the issue. Meanwhile, the real problem continues to metastasize, now hidden behind a curtain of well-intentioned but ultimately irrelevant activity. A company losing market share to a technologically superior competitor might respond by cutting prices. This addresses the symptom, but not the disease. Sales might stabilize briefly, but now the company has lower margins and still doesn't have a competitive product. They've made their situation worse while convincing themselves they've solved the problem. Or consider the organization that responds to customer complaints by implementing new training programs for customer service staff, when the real problem is that the product has become difficult to use compared to alternatives. They've invested in the wrong solution, and meanwhile, customers continue to leave, now frustrated by both the product and the extra time spent on calls with newly trained representatives who still can't solve the underlying issue. This brings us to another critical pattern. Failing to learn quickly from small failures leads to big ones. Every major disaster is preceded by minor disasters. Every catastrophic failure is preceded by recoverable failures. The question is whether the organization treats these early failures as learning opportunities or as isolated incidents to be explained away. Small failures are gifts. They're low-cost lessons that reveal weaknesses before those weaknesses become fatal. A product launch that underperforms in one region shows you what won't work before you roll it out nationally. A pilot program that fails teaches you what to fix before you commit the entire organization. A new strategy that doesn't deliver expected results in quarter one gives you time to course correct before quarter four. But only if you're willing to learn. Only if you're willing to ask hard questions about why something didn't work. Only if you're willing to change based on what you discover. Too often, organizations explain away small failures rather than learning from them. That market was unique. We didn't have enough time. The timing was off. We didn't execute well enough. These explanations might all be true, but they prevent learning. They let the organization preserve its beliefs about what should work, rather than updating those beliefs based on what actually does work. And so the small failures accumulate. Each one is rationalized individually. None of them seems catastrophic on its own. But collectively, they're trying to tell the organization something. That its assumptions are wrong, that its strategy is flawed, that its approach isn't working. The organization that learns from these signals can adapt. The one that explains them away marches confidently toward a much larger failure. The pattern is especially clear in companies that fail to run proper experiments or, worse, run experiments but ignore the results. They launch a new product feature that customers don't use, but instead of asking why, they assume customers need more education. They test a new business model that doesn't gain traction, but instead of reconsidering the model, they blame the execution. Each small failure could have been a course correction. Instead, each becomes another step toward collapse. There's one more early warning sign that deserves attention, precisely because it often doesn't look like a warning at all. In fact, it usually looks like strength, overconcentration on one product or revenue stream. This magnifies risk in ways that aren't apparent during good times. When a company has one hugely successful product, it's easy to see this as a blessing. Revenue is predictable. The organization knows how to sell it, support it, improve it. Wall Street loves the focus. Customers trust the specialization. Everything about the situation feels positive. Until the market shifts. Until a competitor introduces something better. Until technology changes the underlying need. Until regulation impacts the product. Until any one of 1,000 possible disruptions occurs. And suddenly, the concentration that looked like strength reveals itself as catastrophic vulnerability. A company with diverse revenue streams can weather the decline of one product line. It has time to adapt, to shift resources, to develop new offerings. But a company that derives 80 or 90% of its revenue from a single source has no cushion. When that source is threatened, everything is threatened simultaneously. The warning sign isn't the concentration itself. It's the complacency that comes with it. When times are good, there's no apparent reason to diversify. The successful product generates so much cash that investing in new areas seems like a distraction. Why would you divert resources from what's working to explore what might work? The answer, of course, is that what's working now won't work forever. But this is easy to say and hard to act on, especially when quarterly pressures demand that you maximize short-term results. Investing in diversification means sacrificing some of today's profits for protection against tomorrow's uncertainties. And most organizations, most of the time, choose today. So they concentrate further. They double down on what's working. They become the world's best at one thing, which makes them exquisitely vulnerable to any change that makes that one thing less valuable. They're perfectly optimized for a world that no longer exists the moment it shifts. The executives who make these choices aren't irrational. They're responding to real pressures from boards, from shareholders, from markets that punish long-term thinking and reward short-term performance. But the result is the same. Organizations that look strong are actually fragile, and the fragility only becomes apparent when it's too late to do anything about it. These early warning signs, the ignored frontline signals, the misdiagnosed problems, the unlearned lessons from small failures, the concentrated risk, they don't exist in isolation. They compound each other. The organization that ignores its frontline employees is the same one that misdefines problems, which leads to wrong fixes, which become small failures that aren't learned from, all while the business becomes increasingly concentrated on what used to work. And through it all, from the outside, everything might still look fine. The earnings are strong. The stock price is stable. The brand is respected. But inside, the cracks are spreading, and the foundation is weakening, and the collapse is already in motion even if no one with power is willing to see it yet. Chapter 3. Growth, Leverage, and False Momentum. There's a particular intoxication that comes with growth. Revenue climbing month after month. New markets opening. Headcount expanding. Office space multiplying. The energy is electric. The confidence is contagious. And the future seems limitless. This is when companies feel most alive, most powerful, most certain of their destiny. And this is often when they're most vulnerable. Growth is seductive because it feels like validation. Every new customer, every new market, every uptick in revenue seems to confirm that the strategy is working, that the product is right, that success is inevitable. In boardrooms and investor presentations, growth becomes the answer to every question. Concerns about profitability? We're focused on growth. Questions about competitive threats? Look at our growth. Doubts about the business model? The growth speaks for itself. But rapid growth without solid foundations is dangerous in ways that only become apparent when the momentum stops. It's like constructing a skyscraper at tremendous speed without properly reinforcing the lower floors. For a while, everything seems fine. You're building up, making visible progress, achieving impressive heights. The problems only reveal themselves when the weight of what you've built becomes too much for the foundation to bear. What are these foundations? They're the unglamorous parts of business that don't make headlines. Strong financial controls, robust operational systems, clear decision-making processes, deep customer relationships, sustainable unit economics, a coherent culture. These things take time to build, and during rapid growth, there never seems to be time. There's always another market to enter, another product to launch, another competitor to outpace. So companies grow first and figure out the foundations later. They'll professionalize the finance team after this funding round. They'll implement proper systems after they hit this revenue milestone. They'll strengthen the culture once they finish this expansion. Later. Meanwhile, the organization becomes increasingly chaotic, increasingly fragile, held together by the sheer momentum of growth rather than any underlying structural integrity. The employees who join during this phase often don't realize how precarious things are. They see the growth and assume it's built on something solid. They don't know that basic questions like, what's our customer acquisition cost? Or what's our churn rate? Or what are our actual margins on this product? Don't have clear answers. Or worse, they have answers, but the answers are alarming, and everyone has agreed not to think about them because growth is the priority. This pattern becomes even more pronounced during overexpansion without operational discipline. Growth isn't just about revenue increasing. It's about deliberately scaling the business into new territories, new products, new customer chapters. And when this expansion happens without the discipline to ensure each new venture is actually working, the results can be catastrophic. Expansion feels like progress. A retail chain opening 100 new stores. A software company launching in 20 new countries. A manufacturer building new production facilities across multiple continents. Each expansion is celebrated, covered in the press, touted to investors. The company is growing, expanding, winning. But each new location, each new market, each new product line adds complexity. It requires capital, attention, management capacity, operational sophistication. And if the discipline isn't there to ensure that each expansion actually makes sense, that the unit economics work, that there's real demand, that the company can actually operate effectively in that context, then what looks like growth is actually the accumulation of future problems. The undisciplined expander opens stores in markets they don't understand. They launch products without validating demand. They enter countries without adapting to local conditions. And because they're expanding so rapidly, they don't have time to learn from each move before making the next one. Mistakes that could have been contained become systematic. Weaknesses that could have been corrected become embedded across the entire expanded operation. The particularly insidious thing about overexpansion is that it can look successful for quite a while. Revenue is growing because there are more locations, more products, more markets. The top line is impressive. The growth story is compelling. But underneath, many of these new ventures are unprofitable or barely break even. The company is growing itself into a larger version of an increasingly broken business model. And success is inevitable. This expansion is funded not by profits from the presentations, but by growth debt becomes the answer to every question. One of the most dangerous dynamics in profitability. Debt focused on growth business models. Questions about competitive threats. Debt is a tool. Look at our growth. And like any tool, doubts about the business model wisely. The growth speaks for itself. Used wisely, but rapid growth allows companies to invest in growth opportunities in ways that only become apparent exceeding the cost of capital. It's like constructing a skyscraper. It allows companies to paper over fundamental problems, reinforcing the lower floors. To keep operating long after the business model everything seems proven itself unsustainable. You're building up to maintain the illusion of progress. While achieving impressive heights slips further away. The problems only reveal themselves when the weight of what you've built becomes too much for the foundation to bear. Would this expansion make sense if we had to fund it entirely from glamorous parts of business? If the answer is no, headlines, then the debt isn't enabling financial controls. It's enabling the avoidance of hard truths about whether the decision-making is actually viable. The dangerous allure of debt is that it makes everything seem possible. A coherent you don't have culture. To choose between investments. These things take time to build. You can make them all. And during rapid growth, you don't have to prioritize. There never seems to be time. You can pursue every opportunity. Another market to enter. You don't have to operate profitably right now. Another competitor focus on growth and worry about profitability first and figure out the foundation scarcity would impose. They'll professionalize the finance by the false freedom of borrowed money. They'll implement proper systems borrow to expand, then borrow to support the expansion. They'll strengthen the culture borrow to service the previous expansion. The debt compounds later. The interest payments grow. The organization becomes increasingly chaotic, make those payments, increasingly as fragile, long as lenders remain together by the sheer momentum of growth. The fundamental question underlying the structural integrity works. The employees who join during this phase can't be often don't realize how precarious things are. Or a recession hits, they see the growth or competition intensifies built on something solid. Or interest rates rise. They don't know that basic or any number of factors. What's our customer acquisition cost? That the business isn't generating enough cash to service its debt. What are our actual margins on this product? Very quickly. Don't have debt clear transforms answers. From a tool into a noose. They have answers. The tragedy but the answers is that are debt often masks and everyone has agreed not to think about them if they've been confronted earlier. Priority. A business pattern model with even more pronounced might during overexpansion, significant without operational discipline. But those changes are growth painful. Isn't just about revenue increasing and would require it's about deliberately scaling the business working into new territories. That allows the company new to products, avoid making those changes. Customer chapters to keep operating. And when this expansion happens without the discipline to ensure becomes so large that no amount of fixing can save the situation. Can be catastrophic. This connects directly to perhaps like the most underappreciated retail chain opening 100 new stores. Management kills. A software company launching in 20 new countries. Alarming regularity. A manufacturer building new production facilities customers across multiple market need. Each expansion is celebrated because you run out of cash. Touted cash to investors flow is one of those concepts the company is that growing, simple, expanding, proves devastatingly complex. But each new location, each revenue new market, is not cash. Each new product line is not adds cash. Complexity. A company requires capital and profitable attention, on paper, management simultaneously running out of operational sophistication. This happens when customers pay discipline slowly. Isn't there to ensure when inventory that each ties expansion actually makes sense. When expansion requires that the unit economics work. When the timing of cash coming in that the company can actually operate cash going out in that context. The growth phase then what looks like growth is actually the accumulation of future problems. Growth consumes cash. The undisciplined expander pay for inventories and before you sell it. They don't understand. You have to hire employees. They launch products before they generate revenue. Validating demand. You have to invest in countries and infrastructure without adapting before they improve efficiency. And because they're expanding so rapidly, every new product, every time to learn requires cash upfront before making the next one later. Mistakes for companies that growing rapidly contained become systematic. A treadmill effect. Weaknesses that could have been corrected become more cash across the entire expanded operation. Ultimately profitable. Particularly insidious thing about overexpansion is that it can look successful will eventually generate returns. Revenue is growing because there are more locations. The company is constantly chasing its own growth. The top line is impressive. More cash. The growth story is compelling. But underneath, many of these new ventures are unprofitable or barely break even. The company is growing itself into a larger version of an increasingly broken business model. And here's where poor cash flow management becomes fatal. It's not that the business doesn't work, it's that the timing doesn't work. The company is selling products that customers want, making margins that should be sustainable, building something of real value. but they've grown too fast relative to their cash position. They've taken on commitments they can't fund. They've assumed that the next funding round or the next big sale or the next payment from customers would come in time. When it doesn't, when the cash runs out even temporarily, everything unravels with shocking speed. Suppliers demand payment and stop shipping. Employees miss payroll. Creditors call in loans. Even if the business would be viable with proper cash management, even if the underlying model is sound, the company can find itself unable to operate simply because it doesn't have cash to meet this week's obligations. The most painful failures are the ones where everyone involved knows the business could work, where customers still want the product, where employees are still committed, where investors would still support the company if it could just get through this cash crunch. But cash flow doesn't care about potential. It doesn't care about what would work if you had 6 more months. It cares about whether you can pay your bills today. Poor cash flow management often stems from the same optimism that drives rapid growth. Leaders assume that growth will continue, that customers will pay on time, that the next funding round will close smoothly. They make commitments based on best-case scenarios rather than building in buffers for when things don't go as planned. And in business, things rarely go exactly as planned. The company that manages cash flow well maintains reserves, negotiates payment terms carefully, monitors receivables obsessively, and makes conservative assumptions about when money will actually arrive. This discipline feels constraining during growth phases. It means saying no to opportunities, growing more slowly than competitors, maintaining cash reserves that could be invested elsewhere. But it's the difference between a business that survives inevitable rough patches and one that doesn't. What makes this entire dynamic so treacherous is that growth, leverage, and false momentum create a self-reinforcing cycle. Growth requires cash, which leads to debt, which enables more growth, which requires more cash, which leads to more debt. The momentum feels real because things are happening, the company is expanding, revenue is increasing. But it's not sustainable momentum built on solid foundations and positive cash flow. It's precarious momentum built on leverage and optimism, on the assumption that growth will solve all problems eventually. And sometimes it does. Sometimes companies grow through this phase, eventually reaching a scale where operations stabilize, cash flow turns positive, and the foundation catches up to the structure built on top of it. But often they don't. Often, the weight becomes too much, the cash runs out, the debt becomes unsustainable, and the entire edifice collapses, not despite the growth, but because of it. The expansion phase, when everything feels most promising, is often when the seeds of destruction are being sown. And the leaders making these decisions usually aren't reckless or incompetent. They're optimistic, ambitious, responding to competitive pressure and market opportunities. They're trying to win, but in their pursuit of growth, they're building something that cannot sustain itself. And by the time this becomes clear, it's often far too late to build the foundations they skipped in their rush to the top. Chapter 4. Culture quietly turns toxic. If you were to ask executives at a failing company when things started going wrong, they would likely point to market shifts, competitive pressures, or strategic missteps. They would talk about technology disruptions or economic downturns. What they rarely mention, and often don't even see, is that the culture had been rotting from the inside for years before the external collapse became visible. Culture and communication can quietly undermine everything a company has built. Not dramatically, not obviously, but through 1,000 small compromises, 1,000 conversations that don't happen, 1,000 truths that go unspoken. Culture isn't something separate from business performance. It's the invisible architecture that determines whether anything else can work. The word culture gets thrown around so much in business that it's lost its weight. It sounds soft, intangible, something you worry about after you've handled the real problems of strategy and operations. But culture is just the accumulated patterns of behavior that people learn are acceptable, rewarded, or punished within an organization. It's what people do when no one is watching. It's what they believe they can say and what they know they cannot. It's the unwritten rules that govern every decision, every interaction, every moment of every workday. And when culture turns toxic, it doesn't announce itself. There's no alarm that sounds, no red light that flashes on the executive dashboard. Instead, it manifests in subtle ways. People stop speaking up in meetings. Information starts flowing selectively. Teams begin protecting themselves rather than collaborating. The truth becomes something to be managed rather than sought. And slowly, imperceptibly, the organization loses its ability to see reality clearly, which means it loses its ability to respond to reality effectively. The descent often begins with success. When a company is winning, when growth is strong and profits are healthy, there's less tolerance for dissent. Why question what's working? Why raise concerns when everything seems fine? The people who push back, who point out problems, who ask difficult questions start to seem like pessimists, troublemakers, people who don't get it. And gradually, they learn to stay quiet. This creates an environment where bad news doesn't travel up. Leaders receive a filtered version of reality, one where problems are minimized and successes are amplified. They make decisions based on incomplete or misleading information, and when those decisions don't work out, they don't understand why. They've lost the feedback loops that would help them course correct because the culture has taught people that delivering bad news is dangerous. Communication breakdowns compound exponentially in large organizations. A small misunderstanding at the executive level becomes a significant confusion at the middle management level and complete chaos on the front lines. Instructions that seem clear at the top arrive at the bottom garbled and contradictory. Feedback from the bottom gets summarized and sanitized until it's unrecognizable at the top. But the real damage happens in the silence. The projects that everyone knows are failing, but no one wants to be the first to say so. The strategies that aren't working but have powerful advocates who cannot be questioned. The ethical concerns that people raise privately but never formally because they've seen what happens to whistleblowers. The culture doesn't just fail to communicate. It actively suppresses the communication that matters most. One of the most powerful forces shaping culture, though it's rarely discussed this way, is that incentives quietly shape behavior, for good or bad. Show me how someone is compensated, and I'll show you how they'll behave. Show me what gets rewarded, and I'll show you what the organization will get more of. Show me what gets punished, and I'll show you what will disappear, at least from view. The challenge is that incentives are rarely aligned as neatly as leaders believe. A company might say it values long-term customer relationships, but if salespeople are compensated purely on new customer acquisition with no consideration for retention, what behavior will dominate? A company might claim to prioritize quality, but if production managers are bonused entirely on volume and speed, what will actually happen on the factory floor? These misalignments aren't usually intentional. They emerge from the complexity of trying to measure and reward performance in a large organization. You can't measure everything, so you measure what's easiest to quantify. Revenue is easier to measure than customer satisfaction. Unit production is easier to measure than product quality. Individual performance is easier to measure than team collaboration. And so, without anyone quite intending it, you build an incentive structure that drives behaviors that undermine your stated values. The toxicity accelerates when incentives create competition within the organization rather than directing it outward toward actual competitors. When departments fight over resources and credit. When individuals succeed by making colleagues look bad. When information becomes a source of power to be hoarded rather than shared. The organization turns inward, consuming its own energy in internal battles, while external threats go unaddressed. Short-term incentives are particularly corrosive. When executives are rewarded for quarterly performance, when bonuses are tied to annual metrics, when stock options vest over just a few years, the rational response is to optimize for the short term even at the expense of long-term health. Why invest in things that will pay off in 5 years when you'll be measured on results in 5 months? Why address systemic problems when you can deliver short-term numbers by cutting costs, deferring maintenance, or pushing problems into the future? This is how you get companies that hit their quarterly targets quarter after quarter while simultaneously destroying their ability to compete in the long run. The incentives are working exactly as designed, driving people to do what they're rewarded for doing. The problem is that what they're rewarded for doing isn't what the company needs. And often, the worst behaviors aren't explicitly rewarded. They're simply not punished. The executive who screams at subordinates but delivers results. The manager who takes credit for others' work but is politically connected. The team that cuts corners on safety but meets production deadlines. When these behaviors go unchecked, when the culture tolerates them because the person is too valuable or too difficult to confront, it sends a clear message about what actually matters. This brings us to a critical failure point. Risk management must cover culture, not just numbers. Most organizations approach risk management as a quantitative exercise. They measure financial risks, operational risks, market risks. They build sophisticated models and maintain detailed dashboards. They have committees and reports and regular reviews. But the risks that sink companies often aren't the ones that show up in these models. They're cultural risks. The risk that people won't raise concerns. The risk that problems will be hidden until they're catastrophic. The risk that unethical behavior will be rationalized or ignored. The risk that the organization will collectively deceive itself about the reality of its situation. These risks are harder to quantify, which makes them easier to ignore. You can't put degree of psychological safety or willingness to deliver bad news into a spreadsheet with the same precision as credit default risk or foreign exchange exposure. But in many organizational failures, the cultural risks were far more dangerous than the financial ones. Consider the pattern. A company has a growing problem. People on the front lines see it. They mention it to their managers. The managers, knowing that leadership doesn't want to hear bad news, soften the message or decide it's not worth escalating. The problem grows. More people see it. Some might try to escalate it, but they're told they're overreacting, or they're bypassing the chain of command, or they need to be team players. The problem continues to grow. By the time it reaches a level where it can't be ignored, where it shows up in the numbers that executives actually review, it's become a crisis. The risk wasn't that the problem existed. Problems always exist. The risk was that the culture prevented the problem from being addressed when it was still manageable. No amount of financial risk modeling would have caught this. The risk management system was measuring the wrong things. Effective risk management would include regular assessments of whether people feel safe raising concerns, whether bad news travels up as quickly as good news, whether dissenters are listened to or marginalized, whether the organization rewards truth-telling or punishes it. These are the leading indicators of catastrophic failure, but they require a different approach to risk than most organizations practice. One area where cultural risk manifests with particular clarity is in the supply chain. Ethics and safety in the supply chain are leadership responsibilities, yet they're often treated as someone else's problem. The distant factories, the third-party contractors, the suppliers in countries with different standards, these are kept at arm's length, creating plausible deniability when problems emerge. But supply chain issues are never just supply chain issues. They're cultural issues that reflect the values and priorities of the organization. When a company sources from suppliers with unsafe working conditions, it's making a choice. When it ignores labor violations at facilities producing its products, it's making a choice. When it prioritizes cost savings over ethical considerations, it's making a choice. And these choices reveal and reinforce the company's culture. The rationalization is always similar. We can't control what happens in independent supplier facilities in other countries. We have codes of conduct. We do audits. But if something goes wrong, well, that's the supplier's responsibility, not ours. This compartmentalization allows companies to benefit from low costs while disclaiming responsibility for how those low costs are achieved. Until something goes public, until journalists investigate and reveal the conditions under which products are made, until workers die in preventable disasters, until the disconnect between the company's stated values and its actual practices becomes impossible to ignore. And then the cultural rot is exposed for everyone to see. What these revelations show is that the culture of cutting corners, of prioritizing efficiency over everything else, of treating people as costs to be minimized rather than humans deserving of dignity and safety, that culture doesn't stay contained in distant supply chains. It permeates the organization. If it's acceptable to ignore worker safety in one part of the business system, it becomes easier to compromise on safety elsewhere. If it's acceptable to mislead stakeholders about supply chain practices, it becomes easier to mislead them about other things. The companies that maintain ethical supply chains don't do so because it's easy or cheap. They do so because their culture genuinely values ethical behavior, and that value is expressed consistently across every part of the operation. They accept that some things cost more than the cheapest possible option. They invest in visibility and accountability throughout their supply chain. They treat their responsibility as extending to everyone touched by their business, not just their direct employees. The companies that don't maintain ethical supply chains often find out too late that the short-term savings came with long-term costs they never anticipated. The reputational damage, the legal exposure, the employee demoralization, the customer boycotts. But more fundamentally, they've built a culture that says profits matter more than people, and that culture shapes everything else the organization does. Toxic culture is insidious because it normalizes itself. People who work within it often don't see it as toxic. It's just how things are done here. The fear, the silence, the misaligned incentives, the ethical compromises. They become background conditions that people learn to navigate rather than problems to be solved. And leadership, insulated from frontline reality, may genuinely believe that culture is fine, that morale is good, that the organization is healthy. Meanwhile, the best people leave. They find organizations where they can speak truth, where their values align with actual practices, where they don't have to compromise their integrity to succeed. The people who remain are either those who embrace the toxic elements or those who feel they have no choice. Either way, the organization loses the diversity of thought and perspective it needs to stay healthy. And so the culture quietly undermines everything. The strategy doesn't work because the culture prevents honest assessment of whether it's working. Encourages cutting corners. The innovation dies because the culture punishes the risk-taking that innovation requires. The customer relationships erode because the culture prioritizes short-term extraction over long-term value creation. By the time the external symptoms become obvious, by the time the financial performance reflects the internal rot, the culture is deeply embedded. Changing it would require acknowledging how dysfunctional things have become, which the culture itself prevents. And so the organization continues down a path it can no longer leave, driven by cultural momentum toward an outcome no one chose, but everyone enabled. Chapter 5. Governance Failures and Loss of Control. There comes a point in the trajectory of a failing organization where the collapse shifts from possible to inevitable. It's the moment when the systems meant to prevent disaster are revealed to have been hollow all along, when the checks and balances turn out to have been theater, when the governance structure that everyone assumed was protecting the company is exposed as little more than paperwork and procedure with no real substance behind it. This is the phase where leaders discover they've lost control, if they ever truly had it, where the organization has become too complex to manage, too opaque to understand, too compromised to save. And the tragedy is that governance failures are almost always visible in retrospect, obvious once you know to look for them, but somehow invisible to the people who needed to see them most. Governance is not a formality. It is survival infrastructure. Yet in too many organizations, it's treated as exactly that, a formality. Board meetings become ritualized performances, where pre-approved decisions are rubber-stamped. Committees meet because the bylaws require it, not because there's genuine oversight happening. Reports are filed because regulators demand them, not because anyone is using them to actually govern. The word governance itself has become so associated with compliance and bureaucracy that its fundamental purpose gets lost. Governance exists to ensure that power is exercised responsibly, that decisions are made with appropriate information and oversight, that the interests of stakeholders are protected against the natural tendencies of unchecked authority. It's not a luxury for when times are good. It's essential infrastructure that determines whether an organization can survive times when they're not. But building real governance is hard. It requires people who will ask uncomfortable questions. It requires structures that distribute power rather than concentrating it. It requires transparency that makes leaders vulnerable. It requires slowing down to ensure proper review when speed feels essential. Most of all, it requires a genuine belief that governance matters, that it serves a purpose beyond satisfying external requirements. Without that belief, governance becomes performative. The board of directors is filled with people selected for their willingness to agree with management rather than their willingness to challenge it. They receive carefully curated information designed to lead them to predetermined conclusions. Meetings are scheduled with barely enough time to review materials, much less ask probing questions. Dissent is framed as not being a team player. And gradually, the board transforms from a governing body into an audience. This is how you get boards that are shocked to discover their company was committing fraud, or taking on catastrophic risks, or operating with fundamental business model flaws. They met regularly. They reviewed reports. They asked questions. But the governance was performative, not substantive. No one had the information, the independence, or the courage to truly govern. The failure becomes more acute when you consider that risk ownership must be explicit, not assumed. In poorly governed organizations, risk ownership exists in a fog of ambiguity. Everyone assumes someone else is monitoring and managing critical risks. The board assumes management has it covered. Management assumes the relevant departments are handling it. Departments assume their colleagues in other areas are watching related risks. And so risks that everyone thinks are being managed are actually orphaned, monitored by no one, controlled by no one. This isn't necessarily malicious. It's structural. As organizations grow complex, risks multiply and interconnect in ways that don't map neatly to organizational boundaries. A risk might involve technology, finance, operations, and compliance. Who owns it? The CTO? The CFO? The COO? The general counsel? In practice, without explicit assignment, each might monitor the piece that touches their domain, while the overall risk goes unmanaged. Explicit risk ownership means someone's name is attached to every significant risk. Someone who will lose sleep if that risk materializes. Someone who has the authority to take action and the accountability if action isn't taken. Someone who reports on that risk, not just when asked, but proactively, regularly, with full transparency about its status and trajectory. But explicit ownership also requires something many organizations resist: admitting that risks exist at all. In cultures that punish messengers of bad news, identifying yourself as the owner of a significant risk can feel like volunteering to be blamed when something goes wrong. And so people shy away from ownership, preferring the safety of ambiguity to the exposure of responsibility. The governance structure should force clarity. It should make risk ownership visible. It should ensure that for every significant threat to the organization, there's a specific person responsible for monitoring it, managing it, and escalating when necessary. Without this, even well-intentioned organizations end up with critical risks that fall through gaps in responsibility, discovered only when they've materialized into crises. There's a related misconception that proves particularly dangerous: the belief that external auditors and regulators are your safety net. They're not. They serve important functions, but protecting your organization from its own failures isn't one of them. External auditors review financial statements for accuracy and compliance with accounting standards. That's valuable, but it's backward-looking and focuses on a specific, narrow slice of organizational reality. Auditors aren't looking for strategic mistakes, operational inefficiencies, cultural problems, emerging competitive threats, or business model vulnerabilities. They're checking that you've accurately reported what happened, not assessing whether what happened positions you for long-term success. Moreover, auditors rely heavily on the information you provide them. They test and verify, but they're not investigators hunting for hidden problems. If management wants to hide something, if the organization systems are inadequate to capture certain information, if problems exist in areas the audit doesn't examine, the auditors won't find them. They're not designed to find them. Regulators have a different role, but a similarly limited one. They ensure compliance with laws and regulations in specific domains. They're not assessing the overall health of your business. They're not evaluating whether your strategy makes sense or whether your operations are sustainable. They're checking whether you're following the rules that apply to your industry. Organizations that rely on auditors and regulators as safety nets are fundamentally misunderstanding governance. These external parties provide valuable but limited assurance. They're part of an ecosystem of oversight, not a replacement for internal governance. If your own board and management systems haven't identified a problem, you cannot count on auditors or regulators to catch it for you. The dangerous comfort of external oversight is that it allows internal governance to atrophy. Leaders think, If there were a real problem, the auditors would have flagged it. The regulators would have stepped in. Since they haven't, we must be fine. This logic fails because external parties don't see most of what matters. They see fragments, reports, specific areas of focus. The full picture exists only internally, and if internal governance isn't assembled, no one has. This brings us to perhaps the most insidious governance failure. Complexity can be a smokescreen for misconduct. When organizational structures become sufficiently complex, when financial arrangements involve multiple entities and jurisdictions, when reporting structures are layered and opaque, it becomes nearly impossible for anyone, boards, auditors, regulators, even senior management, to fully understand what's happening. Sometimes complexity emerges naturally from growth and globalization, but often complexity is deliberately cultivated because it obscures. It creates plausible deniability. It makes oversight difficult. It allows problems to hide in the gaps between entities and the spaces between jurisdictions. And it provides cover for misconduct that would be obvious in a simpler structure. Consider corporate structures with dozens of subsidiaries, partnerships, and special-purpose entities. Money flows between them in intricate patterns. Assets move across borders. Liabilities are structured to appear off the balance sheet. Performance is reported in ways that highlight successes and bury failures. Even sophisticated observers struggle to piece together what's really happening. This complexity isn't accidental. It's the result of decisions made by people who understood that complexity serves their interests. Maybe they're hiding fraud. Maybe they're obscuring poor performance. Maybe they're avoiding taxes or regulations. Maybe they're enriching themselves at the expense of shareholders. Whatever the specific misconduct, complexity makes it harder to detect and harder to prove. Good governance demands simplicity, or at least transparency through complexity. If structures are complex, there must be clear documentation, reporting, and oversight that cuts through the complexity to show what's actually occurring. There must be people responsible for understanding the full picture, not just their piece of it. There must be regular, rigorous review that asks, is this complexity necessary? Is it serving legitimate business purposes? Or is it primarily serving to obscure? But in organizations where governance has failed, these questions don't get asked. The complexity is justified with technical explanations that few understand. Questioning it is framed as not understanding modern business. And so the complexity grows, layer upon layer, until the organization becomes fundamentally ungovernable, a web of relationships and transactions that no single person or group can fully comprehend. When the collapse comes, when fraud is revealed or risks materialize or the business model fails, investigators spend months or years unraveling the complexity. They discover structures that served no purpose except concealment. They find decisions that bypassed normal oversight by exploiting organizational complexity. They see how misconduct flourished in the gaps and shadows that complexity created. The executives claim they didn't know. The board claims they weren't told. The auditors claim they weren't given access to certain information. The regulators claim the structure was designed to evade their oversight. Everyone has an excuse, and often, those excuses are partially true. The complexity became so profound that genuine governance was impossible. No one could see the whole picture because the structure was designed to prevent anyone from seeing it. This is the endpoint of governance failure. Not a single dramatic moment where oversight fails, but a gradual erosion where governance becomes increasingly ceremonial, where risk ownership becomes increasingly ambiguous, where external oversight is treated as sufficient, where complexity is allowed to flourish unchecked. Each of these failures compounds the others until the organization reaches a state where it's essentially ungovernable. And here's what makes this so tragic. The people who could have prevented this, board members, senior executives, oversight functions, often don't realize what's happening until it's too late. They're going through the motions of governance. They're attending meetings, reviewing reports, asking questions, but the substance has drained away, replaced by process without purpose, oversight without insight, accountability without consequence. They don't feel like they've failed at governance because they're doing all the things governance is supposed to involve. What they don't see is that governance isn't about the activities you perform. It's about the outcomes you achieve. It's not about whether you have a board meeting. It's about whether that meeting results in better decisions and better oversight. It's not about whether you have risk committees. It's about whether risks are actually being managed. It's not about whether you produce reports. It's about whether those reports contain truth and whether anyone acts on them. By the time governance failure becomes obvious, by the time the lack of real control becomes undeniable, the organization has often already crossed the threshold from salvageable to doomed. The problems have grown too large. The misconduct has progressed too far. The complexity has become too entrenched. The loss of stakeholder confidence has become too complete. Governance that should have been survival infrastructure reveals itself to have been nothing more than facade, and the building it was meant to support collapses into rubble. Chapter 6. Ethics Break. Truth Gets Hidden. There's a particular moment in the decline of an organization when something shifts fundamentally. It's not always dramatic. There's rarely a single decision where someone says, "Today we will abandon our ethics." Instead, it happens gradually, through a series of small compromises, each one seeming reasonable in isolation, each one justified by circumstances, until one day the organization looks in the mirror and doesn't recognize what it's become. This is the tipping point, where an organization that may have started with genuine intentions, with values it believed in, with leaders who saw themselves as ethical people, crosses into territory where ethics are no longer the foundation of decisions, but an obstacle to be managed. And once that crossing happens, once truth becomes something to hide rather than something to seek, the trajectory toward collapse accelerates dramatically. Weak ethics will eventually surface and ruin value. This is one of those truths that sounds like a platitude until you've watched it happen. In the moment, the ethical compromise always seems worth it. The alternative is losing the deal, missing the quarter, disappointing investors, admitting failure. The compromise is small, contained, unlikely to be discovered. It's justified as necessary, as what everyone does, as not really that serious. But ethical compromises are never as contained as they seem. They metastasize. The person who witnesses the first compromise learns that ethics are situational. When they face their own dilemma, they make a similar calculation. The behavior spreads, not through explicit instruction, but through observation and imitation. What began as a single questionable decision becomes a pattern, then a practice, then simply how things are done. And each compromise makes the next one easier. The first time you misrepresent something to a customer, there's internal resistance, discomfort, maybe even guilt. The 10th time, it's routine. The first time you hide unfavorable data from the board, it feels significant. After it becomes habit, you stop thinking about it. The ethical boundaries that once felt fixed reveal themselves to be surprisingly elastic, stretching a little further with each transgression until they're unrecognizable. The organization convinces itself that it's still ethical in the ways that matter. We're not committing fraud. We're just being strategic about what we disclose. We're not lying to customers. We're just emphasizing certain features over others. We're not breaking laws. We're just being aggressive in our interpretation of them. The rationalizations pile up, each one creating permission for the next. Meanwhile, value is being destroyed in ways that won't show up in quarterly reports. Customer trust is eroding as people realize they've been misled. Employee morale is corroding as good people recognize they're being asked to compromise. Partner relationships are weakening as others notice patterns of behavior that make the organization unreliable. Regulatory scrutiny is increasing as small violations accumulate into patterns that attract attention. All of this happens beneath the surface, invisible to the metrics that leadership monitors, until suddenly it isn't. The customer complaints reach a critical mass. The employee speaks to a journalist. The regulator decides to investigate. The partner files a lawsuit. And then everything surfaces at once, and the value destruction that was happening slowly in private becomes immediate and public. The companies that survive ethical crises are usually those where the breach was isolated and the response was immediate and genuine. But organizations that have allowed weak ethics to become systemic, where the compromises run deep and involve senior leadership, rarely recover. The revelation destroys not just the specific value related to the misconduct, but the faith that anything the organization says can be trusted. And without trust, business becomes impossible. This is why the calculation that the ethical compromise was worth it always proves wrong. The short-term gain, the closed deal, the made quarter, the avoided loss, is dwarfed by the long-term destruction when the truth emerges. And in the modern world, with its surveillance, its documentation, its whistleblowers, its investigative journalism, the truth almost always emerges eventually. Which brings us to a critical dynamic that organizations consistently misunderstand. Transparency buys time. Concealment compresses it. When problems occur, and they always do, organizations face a choice about how to handle them. The instinct is often to conceal, to minimize, to obscure, to delay disclosure, to hope the problem resolves itself before anyone notices. This instinct is precisely backward. Concealment doesn't buy time, it steals it. Every day that you hide a problem is a day that the problem likely gets worse, and more importantly, a day that your eventual disclosure will be viewed not just as reporting a problem, but as evidence that you were hiding it. The cover-up becomes its own crisis, often more damaging than the original issue. Transparency, by contrast, buys time in several ways. First, it allows you to control the narrative. You frame the problem, provide context, explain what you're doing about it. You're not reacting to someone else's revelation. You're proactively managing a situation. Second, it builds credibility. Stakeholders learn that you tell them about problems, which paradoxically makes them more likely to believe you when you say things are going well. Third, it mobilizes help. Once a problem is public, you can seek solutions openly, draw on external expertise, and enlist stakeholders in addressing it rather than hiding it from them. The organizations that handle crises best are almost always those that disclose early and fully. They don't wait for problems to be discovered. They don't minimize or spin. They say, here's what happened. Here's what we're doing about it. Here's what we don't know yet. It's uncomfortable. It's scary. It risks immediate negative consequences. But it's almost always less damaging than the alternative. Concealment, by contrast, compresses time in catastrophic ways. You're not just dealing with the original problem anymore. You're dealing with questions about what else you're hiding, why you hid this, who knew about the concealment, whether anything you say can be trusted. The problems compound and interlock, each one making the others worse, until you're facing a crisis that's multiples larger than the original issue would have been. And concealment is exhausting. It requires constant energy to maintain the story, to ensure everyone sticks to it, to monitor for leaks, to prepare for the possibility of discovery. It creates internal tension as people who know the truth struggle with the dissonance of public lies. It divides the organization between those who know and those who don't, creating toxic dynamics of secrecy and suspicion. All of this drains resources and attention from actually solving the underlying problem. The mathematics of concealment are unforgiving. With each day, the likelihood of discovery increases. The number of people who know grows. The documentation trail lengthens. The chance that someone will make a mistake or develop a conscience compounds. And the severity of consequences when discovery happens escalates, because now you're not just dealing with the original problem, but with evidence of deliberate deception. Yet organizations choose concealment remarkably often, particularly those that have already made ethical compromises. Once you've started hiding things, transparency becomes more difficult because it risks exposing previous concealments. You're trapped in a cycle where each hidden truth makes the next concealment more necessary, and each concealment makes future transparency more costly. Eventually, the organization becomes so invested in its lies that truth seems impossible, and it commits fully to concealment, hoping against all evidence that somehow the truth will never emerge. This is when the collapse becomes not just likely but certain, because in the modern world, secrets don't keep. The question is not whether truth will surface, but when, and under what circumstances. Organizations that understand this choose transparency, accepting short-term pain to avoid catastrophic long-term damage. Organizations that don't understand it, or that have already compromised themselves too deeply to return to transparency, end up learning this lesson in the most painful way possible. The destruction of trust through concealment relates directly to what is perhaps the most undervalued asset in business. Reputation is a fragile, compounding asset. It takes years to build and can be destroyed in days. It grows through countless small actions that demonstrate reliability, integrity, and competence. And it compounds. A good reputation makes people more likely to give you the benefit of the doubt, to interpret ambiguous situations favorably, to want to do business with you. This creates a virtuous cycle where reputation enables success, which reinforces reputation. But reputation is also fragile in ways that more tangible assets are not. You can't store it. You can't insure it. You can't rebuild it quickly once destroyed. A factory that burns down can be rebuilt in months. A reputation that's destroyed might never be recovered, or might take decades of consistent ethical behavior to even partially restore. The compounding nature of reputation works in both directions. Just as a good reputation creates positive spirals, a damaged reputation creates negative ones. Once people believe you're untrustworthy, every action is viewed through that lens. Your explanations are seen as excuses. Your promises are met with skepticism. Your successes are attributed to luck or cheating rather than skill. The benefit of the doubt disappears, replaced by active suspicion. Organizations often don't realize how much of their success depends on reputation until they lose it. They think they succeed because of their products, their efficiency, their innovation, and those things matter. But underneath all of them is reputation. The basic trust that customers have that you'll deliver what you promise, that partners have that you'll honor agreements, that employees have that you'll treat them fairly, that investors have that you'll be honest about performance, that regulators have that you'll comply with rules. When reputation fails, everything becomes harder. Customers demand more proof before buying. Partners require more stringent contracts. Employees leave or demand higher compensation for the risk of association. Investors pull back or demand higher returns to compensate for trust deficit. Regulators scrutinize more closely and interpret ambiguities against you. The friction in every transaction increases. The benefit of every doubt disappears, and operations that used to be straightforward become grinding battles. The economic impact is profound but difficult to quantify, which is why it's often underestimated. How do you measure the deals that don't happen because someone chooses not to work with you? How do you calculate the premium you pay because you're not trusted? How do you account for the talent that goes elsewhere, or the partnerships that never form, or the opportunities that never arise because your reputation precedes you? Companies with strong reputations have options. When they encounter problems, stakeholders want to help. When they need capital, investors compete to provide it. When they seek talent, top candidates want to join. When they face scrutiny, they receive the benefit of the doubt. Their reputation is a reserve of trust they can draw on when times are difficult. Companies with damaged reputations have no such reserve. When they encounter problems, stakeholders assume the worst. When they need capital, investors demand steep terms or refuse entirely. When they seek talent, they're left with people who have no better options. When they face scrutiny, every ambiguity is resolved against them. They operate without trust, which means they operate without the margin for error that trust provides. And here's the cruel mathematics of reputation damage. It happens faster than reputation building, and it's often triggered by exactly the kind of ethical breaches and concealment we've been discussing. A company can operate ethically for decades, building a reputation for integrity through thousands of positive interactions. Then a single scandal emerges, a pattern of fraud, a history of concealment, a revelation of systematic misconduct, and years of reputation building evaporate in weeks. The tipping point, when ethics break and truth gets hidden, is often the moment when reputation shifts from asset to liability. Because once an organization has crossed the ethical line, once it's committed to concealment rather than transparency, the question is not whether reputation will be damaged, but how catastrophically. The organization has made choices that, when revealed, will destroy the trust it spent years building. It's operating on borrowed time, and the debt comes due with interest that compounds daily. Some organizations recognize this and try to pull back, to return to ethical operations, to come clean about past mistakes before they're discovered. But this requires a level of courage and honesty that's rare, especially in organizations where the ethical compromises involve senior leadership. It means admitting failure, accepting consequences, and rebuilding from a damaged position. Most organizations instead commit more deeply to concealment, hoping that somehow they can manage the risk, control the narrative, prevent discovery. They can't. The truth finds its way out, as it always does. And when it does, the organization discovers that reputation, that fragile compounding asset they took for granted, that intangible thing they never properly valued, was actually the foundation on which everything else rested. And now the foundation is gone, and everything built upon it is collapsing, and there's nothing to be done but watch it fall and wonder how they convinced themselves that the small compromises, the hidden truths, the damaged ethics were ever worth the cost. Chapter 7. Crisis hits and resilience is tested. There are moments in the life of an organization when everything changes in an instant. A cyber attack locks down systems. A key product is recalled. A natural disaster destroys critical infrastructure. A pandemic shuts down operations. A competitor announces a breakthrough that makes your core offering obsolete. A scandal breaks in the media. A major customer suddenly leaves. These are shock moments, and they reveal in brutal clarity whether an organization has the resilience to survive or whether it will crumble under pressure. The word crisis gets used so casually in business that it's lost its weight. Every missed target, every market fluctuation, every difficult quarter gets labeled a crisis. But true crises are different. They're discontinuous events that fundamentally disrupt normal operations. They demand immediate response. They expose vulnerabilities that were always there but invisible during stable times. And they compress months or years of consequence into days or weeks. What separates organizations that survive crises from those that don't isn't usually the severity of the shock itself. Companies facing similar disruptions, the same pandemic, the same regulatory change, the same market collapse, have wildly different outcomes. Some emerge bruised but intact, or even stronger. Others disintegrate entirely. The difference is almost never the crisis. The difference is resilience, or the lack of it. And here's the uncomfortable truth that becomes painfully obvious during crises. Lack of contingency planning amplifies shocks in ways that transform manageable situations into existential threats. Organizations that haven't prepared for disruption don't just suffer more during crises. They suffer disproportionately more. The impact isn't linear. It's exponential. Contingency planning sounds boring. It's not exciting like growth strategy or innovation. It doesn't generate immediate returns like operational improvements. It's planning for things that might never happen, investing resources in scenarios that seem unlikely. During good times, it feels like a wasteful distraction. Why spend time and money preparing for hypothetical disasters when you could be pursuing concrete opportunities? This is the seduction of normalcy. When things are going well, when operations are smooth, when growth is steady, it's natural to assume that's the state that will persist. Disruptions seem like remote possibilities, black swan events that by definition can't be predicted or planned for. And so planning gets deferred. Resources get allocated elsewhere. The contingency plans that exist become outdated documents that no one reviews or updates. Then the crisis hits. And suddenly, the organization realizes it has no plan for operating when its primary facility is inaccessible. No plan for when its supply chain is disrupted. No plan for when its key systems fail. No plan for when its leadership is incapacitated. No plan for when its cash flow suddenly stops. The shock that could have been managed becomes catastrophic because there's no framework for response, no pre-established protocols, no resources already allocated to deal with it. The scrambling that follows is chaos. Decisions get made under extreme pressure without adequate information. Resources are deployed reactively, often in contradictory directions. Communication breaks down because no one established clear channels for crisis situations. Different parts of the organization respond independently, sometimes working at cross purposes. Valuable time is lost figuring out basic questions that should have been answered long ago. Meanwhile, the organization that did plan for contingencies activates protocols that were developed calmly, when there was time to think through implications and alternatives. They don't have to invent response mechanisms in the moment. They execute plans that were already stress-tested. They don't have to debate who has authority to make which decisions. roles, and responsibilities were pre-established. They don't have to discover their vulnerabilities under fire. They already knew where they were exposed and had mitigations in place. The planning itself forces valuable thinking. Even if the specific scenario you planned for doesn't materialize, the exercise of planning builds organizational muscle for crisis response. It identifies dependencies and vulnerabilities. It establishes communication channels and decision-making processes. It creates familiarity with operating under abnormal conditions. When a different crisis emerges, organizations that have practiced contingency planning adapt faster because they've developed the mental models and organizational structures for responding to disruption. But contingency planning requires admitting vulnerability, which many organizations resist. To plan for failure is to acknowledge that failure is possible. To prepare for disruption is to admit you're not invulnerable. For organizations and leaders caught in the illusion of invincibility we discussed earlier, this admission feels like weakness. And so they don't plan, because planning would require confronting realities they prefer to deny. The irony is that contingency planning doesn't make you more vulnerable. It makes you more resilient. But it requires a mindset shift from optimizing for the most likely scenario to ensuring survival across a range of possible scenarios. It means accepting that efficiency has costs, that redundancy has value, that insurance is worth paying for even when you don't need it. These are difficult trade-offs during stable times, when the benefits are theoretical and the costs are concrete. This connects to perhaps the most important lesson about organizational survival. Resilience is built before crisis, not during it. When the crisis arrives, your capacity to respond is essentially fixed. You either have resilient systems or you don't. You either have resource buffers or you don't. You either have flexible operations or you don't. You either have capable leadership or you don't. There's no time during crisis to build these things. You can only deploy what you already have. Resilience isn't a single characteristic. It's a collection of attributes that work together. Financial reserves that buy you time when revenue drops. Operational flexibility that lets you adapt when conditions change. Technological robustness that keeps systems running under stress. Supply chain diversity that provides alternatives when primary sources fail. Team capability that enables rapid response. Cultural strength that holds the organization together under pressure. Stakeholder relationships that provide support when you need it. Each of these must be built during normal times, which means accepting costs and constraints that seem unnecessary when nothing is wrong. Maintaining cash reserves means having lower returns on capital. Building redundancy means accepting inefficiency. Diversifying suppliers means foregoing volume discounts. Investing in team development means spending on people rather than immediate needs. Strengthening culture means prioritizing long-term health over short-term performance. Building stakeholder relationships means investing in connections that have no immediate payoff. Organizations optimized purely for efficiency, for maximum extraction of value from every resource, for perfect alignment between supply and demand, are fragile. They operate beautifully in stable conditions and shatter under shock. Organizations built for resilience operate with apparent slack in the system, excess capacity, redundant systems, diverse options, resource buffers. That looks like waste until the moment it becomes survival. The tension between efficiency and resilience is one of the fundamental trade-offs in organizational design. During extended periods of stability, markets reward efficiency. Investors push for higher returns. Competitors who operate more leanly can undercut prices. The pressure to optimize, to eliminate redundancy, to run just-in-time systems, to maximize every metric becomes intense. And organizations respond, stripping away buffers, reducing reserves, concentrating suppliers, automating without backup systems, all in the pursuit of marginal gains. Then comes the shock. The just-in-time system has no inventory when deliveries stop. The concentrated supplier has no alternative when they fail. The automated system has no manual fallback when it crashes. The minimized cash reserves run out within weeks. The optimized organization, stripped of all apparent waste, discovers that what looked like inefficiency was actually the capacity to survive disruption. The organizations that maintain resilience during good times are often criticized for it. They're called conservative old-fashioned, inefficient. Their returns are lower. Their costs are higher. Their operations are less streamlined. Activist investors push them to extract more value, to run leaner, to operate with less buffer. And it's hard to resist this pressure when you can't point to concrete evidence that resilience is necessary. You're preparing for events that haven't happened yet, maintaining capabilities you're not currently using, paying for insurance that might never pay out. But when crisis hits, these organizations discover that the price they paid for resilience was the best investment they ever made. They have the resources to respond. They have the flexibility to adapt. They have the time to figure out solutions before they're forced into desperate decisions. They can make choices rather than simply reacting. They can think strategically rather than just surviving day to day. The fragile organizations, optimized for efficiency, discover the opposite. They're immediately in survival mode. Every decision is made under extreme resource constraint. They have no time to develop thoughtful responses because they're consumed with immediate firefighting. They have no flexibility because they're operating at the limits of their capacity. They have no options because they concentrated everything on a single approach. The shock that should have been manageable becomes existential. And often, the crisis reveals that the supposed efficiency was illusory. The costs that were cut, the redundancies that were eliminated, the reserves that were deployed, they weren't waste. They were structural elements that held the organization together. Removing them didn't make the organization more efficient. It made it more fragile. The savings were real, but they came at the cost of stability that was never valued properly until it was gone. This is why resilience must be built before crisis. Once the shock hits, you can't suddenly create financial reserves. The revenue is gone and capital is expensive or unavailable. You can't suddenly build operational flexibility. Your systems and processes are what they are. You can't suddenly diversify suppliers. Alternatives don't exist or can't scale quickly enough. You can't suddenly develop team capabilities. Learning takes time you don't have. You can't suddenly strengthen culture. Trust is built through years of consistent behavior, not weeks of crisis response. The crisis is a test, and you take the test with whatever preparation you've done. There's no cramming. There's no extra credit. Your score is determined by the work you did long before the test was announced. Organizations that invested in resilience discover they can pass tests they didn't know were coming. Organizations that optimized for efficiency discover they're unprepared for questions they never imagined they'd face. The cruel efficiency of crisis is that it compresses time and amplifies consequences in ways that prevent correction. In normal operations, if you make a mistake, you usually have time to recognize it, adjust, and try again. Performance degrades gradually, giving you feedback and opportunity to respond. But in crisis, mistakes compound rapidly. A decision that would have minor consequences in stable times can be catastrophic under stress. And the pressure of crisis impairs decision-making precisely when decision-making matters most. This is why organizations without contingency plans and without built resilience often make catastrophic choices during crises. They're operating in survival mode, making decisions under extreme time pressure with incomplete information and severe resource constraints. They're trying to invent responses in real time while dealing with the consequences of not having prepared. The cognitive load is overwhelming. The emotional stress is intense. And the decisions they make, though understandable given the circumstances, often make things worse. They take on expensive emergency financing that saddles them with unsustainable debt. They make desperate deals with terms that will haunt them for years. They cut costs in ways that damage their ability to recover. They abandon strategic positions that took years to build. They burn relationships with partners and customers in ways that can't be repaired. Each decision seems necessary in the moment, the only option available, but collectively they transform a crisis that could have been survived into a collapse that becomes inevitable. The shock moment, when it comes, doesn't create fragility. It reveals fragility that was always there. The organization that crumbles wasn't destroyed by the crisis. It was destroyed by the choices made during years of stability. The choices to optimize efficiency over resilience, to defer contingency planning, to operate without buffers, to build something that could only function under ideal conditions. The crisis just exposed what was already true, that the organization was built to be fragile, and fragile things break when stressed. Chapter 8. Aftermath, Accountability, and Consequences. After the crisis, after the collapse, after the moment when everything that could go wrong has gone wrong, there's a strange quiet. The chaos subsides. The immediate panic fades. And what remains is an organization that must figure out whether it can survive, whether it can rebuild, whether there's any path forward from the wreckage. This is the aftermath, and what happens in these crucial months often determines whether a company that's fallen can rise again or whether the decline continues until nothing remains. The aftermath is where consequences become real. During the crisis itself, everyone is too busy responding, too focused on immediate survival, to fully reckon with how things got so bad. But afterward, when the dust settles, the questions become unavoidable. How did this happen? Who was responsible? What needs to change? And most importantly, can the people who led us into this disaster be trusted to lead us out of it? This last question is perhaps the most critical, because turnarounds require visible accountability at the top, not as a matter of justice or punishment, though those considerations exist, but as a practical requirement for organizational recovery. A company that's collapsed has lost the trust of everyone: customers who feel betrayed, employees who feel misled, investors who feel deceived, partners who feel abandoned, regulators who feel defied. Rebuilding that trust requires demonstrating that things are genuinely different now, that the organization has learned from its failures, that it won't repeat the same mistakes. And nothing demonstrates genuine change more clearly than accountability at the leadership level. When the executives who presided over the collapse remain in power, it sends an unmistakable message. Nothing fundamental has changed. The same people who made the decisions that led to crisis are still making decisions. The same judgment that proved catastrophically flawed is still guiding strategy. The same culture that enabled failure is still in place, just wrapped in new rhetoric about lessons learned and moving forward. Stakeholders aren't fooled by this. They see leadership continuity and conclude, often correctly, that the changes are cosmetic rather than substantive. They hear promises of reform and remain skeptical because the people making the promises are the ones who broke the previous promises. They're asked to trust the organization again, but trust requires believing that something meaningful has changed, and nothing signals change like new leadership. This is why turnarounds so often require leadership transitions. Not because the existing leaders are necessarily bad people or because punishment is the goal, but because their continued presence makes genuine transformation nearly impossible. They're too associated with the failure. Their credibility is too damaged. Their judgment is too suspect. Even if they've genuinely learned from mistakes, even if they're capable of leading differently, the perception of unchanged leadership undermines the turnaround before it begins. The resistance to leadership accountability is predictable and understandable. Leaders who presided over decline don't see themselves as responsible for it. They have explanations: market conditions, competitor actions, unexpected events, subordinate failures. They're partially right. Organizational failure is rarely the result of a single person's decisions. But leadership means accepting responsibility for outcomes, not just claiming credit for successes. The leader who takes credit when things go well cannot credibly deflect blame when things go poorly. Boards struggle with this too. They're often complicit in the failures, having approved strategies, overlooked warning signs, and supported leadership through the decline. Holding leadership accountable means implicitly acknowledging their own failures of oversight. It's easier to frame the crisis as external circumstances beyond anyone's control and give existing leadership another chance. But this path almost always extends the decline, rather than reversing it. Visible accountability doesn't necessarily mean wholesale replacement of leadership. Sometimes it's the CEO who must go, but other executives can remain. Sometimes it's a broader sweep of the executive team. Sometimes it's board members who should resign. The specifics depend on where responsibility for failure actually resided. But there must be accountability at the level where consequential decisions were made, and it must be visible enough that stakeholders can see that real consequences followed real failure. This accountability creates space for the next critical element of turnaround. Openness about mistakes can save the business. In the aftermath of collapse, organizations face a choice about how to communicate what happened. The instinct is often to minimize, to focus on the path forward rather than dwelling on the past, to control the narrative in ways that preserve as much reputation as possible. This instinct is counterproductive. The organization's credibility is already destroyed. Stakeholders already know that something went badly wrong. Trying to spin the narrative or minimize the failure just confirms that the organization still hasn't learned, that it's still more interested in managing perception than confronting reality. It squanders the one opportunity the aftermath provides, the chance to rebuild trust through radical honesty. Openness about mistakes is uncomfortable. It means admitting things that leadership would prefer remained hidden. It means providing detail about failures rather than vague acknowledgments of challenges. It means being specific about what went wrong, why it went wrong, and who is responsible. It means resisting the temptation to blame external factors exclusively and acknowledging internal failures of judgment, process, and culture. But this openness is precisely what enables recovery. When an organization is genuinely transparent about its failures, several things happen. First, it establishes that the organization is now operating differently, that the culture of concealment has ended. Second, it provides stakeholders with the information they need to make informed decisions about whether to continue relationships with the company. Third, it prevents the drip of revelations that extends crisis indefinitely, with each new disclosure reigniting doubts and restarting the clock on trust building. The companies that recover from scandal or collapse most effectively are usually those that conduct thorough internal investigations, often with external oversight, and publish the findings even when they're damaging. They don't bury unflattering details. They don't spin uncomfortable truths. They present a clear, honest accounting of what happened and why. It's painful in the moment, but it draws a line. This is what we were. This is what we've learned. This is what we're becoming. This openness must extend beyond just the facts of what went wrong. It must include acknowledgement of the impact on stakeholders, customers who were harmed, employees who suffered, investors who lost money, communities that were damaged. The organization must demonstrate that it understands the consequences of its failures for others, not just for itself. This empathy, this acknowledgement of harm beyond shareholder value, is essential for rebuilding the relationships that business requires. But openness alone isn't sufficient if the organization hasn't actually learned from its mistakes. And here's where many turnarounds fail. They go through the motions of accountability and transparency without making the fundamental changes necessary to prevent recurrence. They replace leadership but maintain the same structures, incentives, and culture that enabled failure. They acknowledge mistakes but implement only superficial reforms. They apologize but don't genuinely change. Real learning requires deep organizational introspection. What incentives drove the behaviors that led to failure? What cultural norms enable misconduct? What governance failures allowed problems to grow unchecked? What strategic assumptions proved wrong? What capabilities were lacking? These questions must be asked honestly and answered completely, even when the answers are uncomfortable. And then the organization must act on those answers. Change the incentive structures that rewarded short-term thinking. Reform the culture that punished dissent. Strengthen the governance that failed to provide oversight. Revise the strategy based on corrected assumptions. Build the capabilities that were missing. Transform the organization in ways that make repeating the same failures genuinely difficult. This transformation often requires outside perspective. Leaders who were part of the failed organization, even well-intentioned ones who recognize mistakes, often can't see their own blind spots. They need external advisors, new board members, consultants with relevant turnaround experience, people who can identify patterns and problems that insiders have normalized. This external perspective is invaluable for identifying what actually needs to change versus what the organization assumes needs to change. There's one more pattern in the aftermath of collapse that deserves attention because it's so consistently destructive. M&A without integration thinking destroys value, and this becomes especially acute when struggling companies attempt acquisitions as part of their turnaround strategy. The logic seems sound. The company is struggling, so acquire capabilities or market share that can jumpstart recovery. Buy a competitor and gain their customers. Acquire a company with the technology you lack. Purchase entry into a new market that offers growth opportunities. On paper, these moves look like solutions. In practice, they often accelerate decline. Acquisitions are complex under the best circumstances. They require careful due diligence, thoughtful integration planning, and disciplined execution. The acquiring company must have the management bandwidth to oversee integration, the cultural coherence to absorb new employees, the operational sophistication to merge systems, and the strategic clarity to ensure the combined entity makes sense. A company in the aftermath of collapse has none of these. Management is stretched thin dealing with the crisis and its consequences. Culture is fractured and demoralized. Operations are struggling with basic functioning. Strategy is unclear or in flux. This is the worst possible time to take on the additional complexity of an acquisition. But the pressure to do something, to demonstrate action and vision, to show stakeholders that leadership has a plan for recovery, often drives companies toward acquisitions. They're visible. They make news. They can be sold as transformative moves. They offer the hope of solving problems through external growth rather than internal reform. And they delay the hard work of fixing what's broken. The acquired companies almost never integrate well. The parent company lacks the capacity to properly onboard them. Cultural integration, always challenging, becomes impossible when the parent's culture is itself damaged. Systems don't get unified because no one has time to manage the technical complexity. Promised synergies don't materialize because achieving them requires coordination that the struggling organization can't provide. Meanwhile, the acquisition consumes resources that could have been used for actual recovery. Capital that could have stabilized the core business or funded necessary reforms goes to purchasing another company. Management attention that should be focused on turnaround gets diverted to acquisition integration. Employee energy that's needed for transformation gets spent on merger-related activities. And often, the acquired company begins to struggle too, infected by the dysfunction of its new parent. Talented employees leave. Customers become uncertain about the combined entity. Operations that worked well independently falter under new ownership. The acquisition, meant to strengthen the struggling company, instead spreads the struggling company's problems to a previously healthy organization. This pattern is so consistent that it should be a red flag. Companies in distress that announce acquisitions are usually making their situation worse, not better. There are exceptions, situations where acquisition is genuinely strategic and properly resourced, but they're rare. More commonly, M&A during or shortly after crisis is a sign that leadership still doesn't understand what went wrong and is seeking external solutions to internal problems. The aftermath demands focus. Every resource, every ounce of management attention, every strategic initiative should be directed at one goal: fixing what's broken. This means saying no to distractions, no matter how appealing they seem. It means resisting the pressure to do something dramatic and instead doing the unglamorous work of organizational repair. It means acknowledging that recovery is a long process of steady improvement, not a single transformative move. The companies that successfully turn around are almost always those that accept this reality. They install leadership capable of executing turnarounds. They're radically honest about what went wrong. They make fundamental changes to strategy, operations, and culture. They focus ruthlessly on core business recovery. They rebuild stakeholder trust through consistent performance over time. And they resist the temptation of acquisition or other supposed shortcuts that promise quick recovery but deliver extended decline. The aftermath, focus, and the discipline to do the hard work of genuine transformation rather than the easier work of cosmetic change and strategic distraction. Chapter 9. The legacy every failure leaves behind. When a company collapses, when the final chapter is written and the assets are liquidated or absorbed by others, there's a tendency to move on quickly. The business press covers the story, perhaps writes a post-mortem or two, and then attention shifts to the next crisis, the next scandal, the next collapse. The people directly involved, employees who lost jobs, investors who lost money, communities that lost an economic anchor, carry the consequences. But for the broader business world, the failure becomes just another cautionary tale, a data point in the long history of corporate mortality. But failures don't simply disappear. They leave legacies that ripple outward in ways that aren't always visible, but are deeply consequential. Every downfall leaves a regulatory and industry legacy that shapes how business is conducted long after the failed company is gone. This is one of the least appreciated aspects of corporate collapse. That failure, paradoxically, has profound influence even in death. The most obvious legacy is regulatory. When companies fail spectacularly, particularly when that failure involves fraud, misconduct, or harm to stakeholders who couldn't protect themselves, regulators respond. They investigate what went wrong. They identify gaps in existing rules that allowed the misconduct or failure to occur, and they create new regulations designed to prevent similar failures in the future. This pattern has repeated throughout business history. The accounting scandals of the early 2000s produced Sarbanes-Oxley, fundamentally changing corporate governance and financial reporting requirements. The financial crisis of 2008 produced Dodd-Frank, reshaping banking regulation and consumer protection. Major product failures lead to safety regulations. Environmental disasters lead to stricter environmental rules. Data breaches lead to privacy laws. Each major failure becomes the justification for new regulatory infrastructure. These regulations affect far more than just the companies that failed. They apply to entire industries, to thousands of companies that weren't involved in the original failure, but must now comply with rules created in response to someone else's misconduct. The compliant companies, the ones that were already operating ethically and safely, find themselves subject to new requirements, new compliance costs, new constraints on how they can operate. There's a tragic irony here. The companies that failed, that caused the problems requiring regulatory response, are often gone by the time the regulations take effect. They don't bear the cost of compliance because they no longer exist. Meanwhile, their competitors and industry peers, including many who were operating responsibly all along, must adapt to a new regulatory environment they didn't create and didn't need. This creates a legacy of increased regulatory burden that persists long after the original failure is forgotten. Industries become more heavily regulated, more compliance-intensive, more constrained in their operations. Barriers to entry increase because new companies must navigate complex regulatory requirements before they can even begin operating. Innovation slows because new approaches must clear regulatory hurdles designed to prevent problems from past failures. None of this is to argue against appropriate regulation. When companies fail in ways that harm stakeholders, when markets prove unable to self-correct, regulatory response is often necessary and valuable. But it's important to recognize that the failed company's legacy includes imposing costs and constraints on an entire industry, fundamentally reshaping how business is conducted in ways that persist for decades. The regulatory legacy is often most visible, but there's also an industry legacy that's subtler but equally important. When a major player collapses, it changes competitive dynamics, shifts market structure, and influences strategic thinking across the industry in ways that endure. Sometimes the legacy is consolidation. The failed company's market share gets absorbed by survivors, creating larger, more dominant players. This can reduce competition, change pricing dynamics, and alter the balance of power between companies and their customers or suppliers. An industry that was competitive becomes oligopolistic. The failure of one creates market power for others. Sometimes the legacy is caution. After a spectacular failure, particularly one that involved a widely adopted strategy or business model, other companies become more conservative. They pull back from similar approaches, even when those approaches might be viable if executed differently. Innovation slows as companies avoid risks associated with the failed model. Capital becomes harder to raise for certain types of businesses because investors are now wary. The failure creates a chilling effect that extends far beyond the company that collapsed. Sometimes the legacy is learning. The industry studies what went wrong, identifies the mistakes, and collectively adapts. Business school case studies get written. Industry conferences feature postmortems. Companies implement new practices designed to avoid similar failures. The collective knowledge of the industry increases, purchased at the price of one company's collapse. This is perhaps the most positive form of legacy, where failure at least produces learning that improves future practice. But often, the learning is incomplete or misapplied. Industries learn the wrong lessons from failures, focusing on superficial aspects while missing deeper patterns. They see a company fail because of fraud and conclude the lesson is about ethics, when the real lesson might be about governance structures that enable fraud. They see a company fail because of a product defect and conclude the lesson is about quality control, when the real lesson might be about cultures that punish people who raise safety concerns. The mislearning can be as consequential as the failure itself, creating industry-wide responses that address symptoms rather than causes, that implement solutions that don't actually solve the underlying problems, that create the appearance of learning without the substance. And so the industry moves forward, confident it has learned from the failure, while remaining vulnerable to similar failures in the future. There's one more legacy pattern worth examining because it appears with such consistency. Companies fail to recognize when their industry is fundamentally changing, and this failure creates opportunities for new players while destroying value for incumbents. Ignoring emerging channels and distribution shifts is costly in ways that often aren't apparent until the shift is complete and reversal is impossible. Every industry has its established ways of reaching customers, its traditional distribution channels, its accepted methods of delivering value. These channels and methods become embedded in operations, strategy, and organizational structure. Companies build their capabilities around serving customers through existing channels. They develop relationships with traditional intermediaries. They optimize their operations for how business has always been done. And then something changes. A new technology enables a different way to reach customers. A new business model bypasses traditional intermediaries. A shift in customer behavior makes old channels less relevant and new ones more important. The change often starts small, on the periphery, easy to dismiss as niche or temporary. But it grows, and as it grows, it fundamentally reshapes how the industry operates. The companies that recognize these shifts early and adapt have the opportunity to maintain or even strengthen their positions. They experiment with new channels while they're still small. They develop capabilities for serving customers in new ways. They're willing to cannibalize their existing business to build their future business. They accept short-term pain for long-term survival. But recognition and adaptation are harder than they sound. The existing channels are still producing most of the revenue. The traditional intermediaries are still powerful and resistant to being bypassed. The organizational capabilities are all built around the old model, toward optimizing the existing business, not building a new one. And the emerging channels look risky, unproven, and unprofitable compared to the established ones. So companies watch the shift happening, often while actively denying its significance. They tell themselves that customers will always prefer the traditional approach, that the economics of the new channels don't work, that they have time to adapt later if the shift proves real, that their brand strength and customer relationships will protect them even as distribution changes. These rationalizations feel reasonable, especially when quarterly performance in traditional channels is still acceptable. Meanwhile, new entrants build businesses optimized for the new channels from day one. They don't have legacy operations to protect or traditional partners to appease. They can move quickly, experiment freely, and accept losses while they learn. And because they're focused entirely on the new channels, they develop capabilities and advantages that incumbents, divided between old and new, struggle to match. By the time the shift is undeniable, by the time traditional channels are clearly declining and new channels clearly dominate, it's often too late for incumbents to effectively respond. They've spent years optimizing for a distribution model that's becoming obsolete. Their cost structures are built for the old model. Their organizational capabilities, culture, and talent are all aligned with ways of operating that customers no longer prefer. They're not just behind. They're fundamentally structured for a world that no longer exists. The failure to adapt to channel and distribution shifts has destroyed countless companies and entire business models. Retail businesses that didn't adapt to e-commerce. Media companies that didn't adapt to digital distribution. travel agencies that didn't adapt to online booking, video rental that didn't adapt to streaming, music labels that didn't adapt to digital downloads, publishing companies that didn't adapt to digital content. The pattern repeats across industries. Established players dismiss emerging channels until those channels have become dominant and adaptation is no longer possible. This creates a particular kind of legacy. Entire categories of businesses that simply cease to exist because they couldn't or wouldn't adapt to fundamental shifts in how customers want to access products and services. The video rental store, the travel agency, the music store, the bookstore. These aren't just individual companies that failed. They're entire business categories that were disrupted out of existence by distribution shifts. For the companies that collapse because of this, the legacy is a cautionary tale about the importance of recognizing and adapting to change. But for the industry, the legacy is more complex. The disruption creates winners and losers. New companies and business models rise to replace the old. Customers often benefit from better service, lower prices, or more convenient access. But there are also costs: jobs lost, communities disrupted, institutional knowledge destroyed, diversity reduced as a few digital platforms dominate what used to be thousands of local businesses. And there's a meta lesson in this pattern, a legacy about the nature of business itself. That distribution advantages are temporary, that customer behavior evolves, that what worked yesterday might not work tomorrow, and that companies must constantly adapt or face irrelevance. This lesson seems obvious in retrospect when we look at failures, but it's extraordinarily difficult to internalize when you're the one operating a successful business built on distribution advantages that are beginning to erode. As we reflect on these legacies, regulatory, competitive, strategic, what emerges is a picture of corporate failure as something larger than just the collapse of individual companies. Each failure is a learning opportunity for those willing to learn, a warning sign for those willing to see it, and a force that reshapes the landscape for everyone who remains. The executives at failing companies influence industry practices and serve as case studies for future generations trying to understand what went wrong and how to avoid similar fates. And perhaps this is the final, most important legacy: that business failure, as painful and destructive as it is for those directly involved, serves a function in the broader economic ecosystem. It eliminates companies that couldn't adapt, couldn't compete, couldn't operate ethically or effectively. It frees resources, capital, talent, market share to be reallocated to more viable enterprises. It generates knowledge about what doesn't work, which is as valuable as knowledge about what does. It creates the evolutionary pressure that drives innovation and improvement. This doesn't diminish the real costs of failure: the jobs lost, the value destroyed, the lives disrupted, the communities harmed. These costs are genuine and significant, but it provides context that in a dynamic economy, failure is not just inevitable but necessary. Not every company should survive. Not every strategy should succeed. Not every business model should endure. The economy needs mechanisms for identifying and eliminating approaches that don't work, and corporate failure is one of those mechanisms. The question isn't whether companies will fail. They will, they must. It's inherent in the nature of market competition and economic change. The question is whether we learn from those failures, whether the legacies they leave make future business more responsible, more resilient, more aligned with stakeholder interests, and more capable of adapting to change. Every downfall is a story that ends, but it's also a story that continues in the legacies it leaves behind, in the regulations it spawns, in the industry it reshapes, in the lessons it teaches to those willing to learn. The companies are gone, but their influence persists, ghostly presences that continue to shape business long after their final chapter has been written. And so we close with reflection that the arc of corporate downfall, from the illusion of invincibility through the warning signs, the toxic growth, the cultural rot, the governance failures, the ethical collapses, the crisis moments, and finally the aftermath, is a pattern that has repeated countless times and will repeat countless more. Each instance is unique in its details, but similar in its dynamics. Each offers lessons for those willing to see them. Each leaves behind a legacy that shapes the future, even as the companies themselves fade into history. The names change. The industries evolve. The specific circumstances vary. But the fundamental patterns of how organizations succeed and how they fail remain remarkably consistent. Understanding these patterns doesn't guarantee success, but ignoring them virtually guarantees eventual failure. And perhaps that's the ultimate legacy of corporate downfall, the accumulated knowledge, purchased at enormous cost, about what it takes to build something that endures and what mistakes will inevitably lead to collapse. As you drift off, consider this, that every organization exists in a delicate balance between the forces that build and the forces that destroy, between adaptation and rigidity, between truth and deception, between resilience and fragility. The companies that thrive are those that understand this balance, that remain vigilant against the patterns we've explored, that build with humility rather than hubris, with transparency rather than concealment, with resilience rather than brittleness. And the companies that fall, they leave behind lessons, regulations, and altered landscapes. They serve as markers on the path, warnings to those who come after. Here is where confidence became arrogance, where growth became recklessness, where culture became toxic, where ethics were compromised, where truth was hidden, where resilience was sacrificed for efficiency, where accountability was avoided, where change was ignored. Learn from these markers. Respect these patterns. Build something that can endure not just success, but also adversity. Not just stability, but also change. Not just the climb to the peak, but also the inevitable moments when the ground shifts beneath your feet. This is the wisdom that failure offers, the legacy that downfall leaves behind, the knowledge purchased at the price of collapse. And with that reflection, we close this journey through the anatomy of corporate downfall, hoping that understanding how organizations fail might help, in some small way, to build organizations that endure.